Welcome back to FT Markets. It's been a big week for regulation of Europe's banks and the financial system. A lot of rules passed in Brussels aimed at making the system safer and preventing taxpayers footing the bill for the next bailouts. One consequence of all these new rules has been the rise of Coco bonds. These are bonds that act like a financial cushion in times of stress, but they're very controversial and some investors worry about whether they're actually safe, whether investors might lose their money. With me to discuss the rise of Coco bonds, will they become Coco Pops, is Philippe Bodereau, who's a managing director and bank finance specialist at Pimco. Philippe, welcome to the Financial Times. Just tell me, why have Coco bonds become so popular and what exactly are they?
So Coco bonds, Cocos, I always think about it as something that provides insurance against financial disasters and something that will provide an extra cushion. If you wish, in simple terms, it's like a pre-underwritten rights issue that protects the banks, the rest of the bank's creditors, and eventually taxpayers against extraordinary losses in those institutions.
And if things go wrong, as I understand, they convert into equity, or you can be wiped out completely.
Right. So there's many differences with very, very different types of Cocos. So it's quite a complex asset class, very heterogeneous. But roughly speaking, that's right. The idea is to have an instrument that gives you loss absorbency, either via equity conversion, typically at a time where investors will not want to own the stocks, or via wipeout of those.
If we look at our first chart, we can see that issuance has been exponential, very strong last year. That's 2014 so far. Where is the issuance coming from?
So the key driver of issuance that we're seeing over the past few months is that in June last year, the European Commission put through this new directive that basically implements Basel III into European law. And as part of that, they've defined how much Tier 1s or Cocos you should have in your capital structure and what they should look like. And since then, you've seen a big pickup in the issuance of those instruments. That really is the key driver. There's other drivers we can talk about.
For regulators, the point is that this is capital that can be absorbed instead of having to use taxpayers' funds.
That's right. And I think that Coco is part of the answer to that too big to fail agenda, if you wish. The other bigger part of the agenda that deals with that is the bail-in rules that have just been voted into Parliament. And that allows regulators ample flexibility to haircut not just Tier 1 Coco instruments, but also sub-debt and eventually senior debt as well.
So you can see why they're attractive for regulators and for the banks themselves. Mm-hmm. But are they safe for investors?
Well, I wouldn't say that they're safe. I think they are risky instruments. But I think you have to think about it whether you are happy with the level of spread or return that you can expect from them versus the risk.
Because obviously you get a better return than you would on a normal bond.
Right. So typically the spread on a Coco or Tier 1 bond is today around 400, 450, and the spread for a senior bond is closer to 50, 70. So there's a very big gap.
That's quite a lot in these days.
Subordination premia. That if you think about it in the sense that the equity cushions in the banking system are going up, which they are because of regulatory pressure, you should have eventually a compression in the capital structure and how it trades.
Okay, and of course what we're seeing at the same time is the financial system is getting stronger. If our second chart shows these are Tier 1 capital ratios, these are capital ratios, are measures of financial strength watched closely by regulators. Presumably, if we see graphs like this strengthening in Western Europe as in the US, some reassurance that maybe Coco bonds will offer a good return and never be converted.
Well, I wouldn't say that it will never be converted because that's
a
bold statement to make.
Not had a crisis.
But I think we are in a part of the cycle, of the regulatory cycle, and also in part of the macroeconomic cycle, where banks' equity is building up fairly quickly under intense regulatory pressure, and that clearly provides a lot of cushion for anything that's above equity, which is the closest to it is Cocos.
And last question, that they've been given the go-ahead now in Germany as well. If Germany approves Cocos, they must be safe.
Well, that's an interesting way to put it. I think in Germany you've got some very levered banks that are quite late in dealing with their lack of shortage of capital issues relative to the rest of the world. And they are trying to compensate that lack of equity by issuing Cocos. And I think you have to think hard whether that's the suitable way to do things.
Okay, Philippe, thank you very much. Coco bonds grown out of the regulatory changes we've seen across Europe could be attractive for investors if banks really have strengthened their finances, but watch out for the motives of banks.